great future. We're talking real money.
Oh my gosh, it's time again for another exciting episode of Talking Real Money. We know you've waited ages for this, and so we better deliver something really good today. And we think we've got something really good for you because it's, I love the headline. I did. The minute I saw this headline, I said, oh, this is it. This is our story. It's from Morningstar. We like Morningstar sometimes. We like some of their stuff. We like this kind of stuff. Love this headline. These fund managers could have gone fishing, not fishing, and earned double the return. A do-nothing portfolio trounced the performance of the average tactical allocation fund.
Which is so important. It's such an important message, and I hope people are getting it. By the way, it reminded me of my father, the doctor, because he hated buy and hold investing. He thought it was horrible. He said, wait, you're just going to watch the market go down? You're not going to do anything? I can remember arguing with him.
Particularly of his generation,
thought it was really stupid.
And some of ours think that is just just being lazy.
I know. What do you mean you're not there trading, et cetera? And we're not going to go into all the numbers on that, but timing the market, not a great strategy.
Well, and let's explain before we get into it what a tactical allocation fund is. They're kind of like hedge funds. They're portfolios run by a manager who believes they have the magical information based on their fancy algorithms to change the allocation of the portfolio in advance of things that happen to either impact securities to the upside or the downside using their fundamental and technical charting squiggly line skills. And they charge a lot more money for their services than do index or relatively passive funds. So you'd think they would make you more money, right?
Market timing. They won't call it that because the term is so been beaten down in the last 30 years, but that's what it is. And we know there's emotions always in the market, right? Can be really positive, can be negative, and so people are sort of prone to second guess where I am today and what changes I need to make. But this is a wonderful article because it points out, and here's the article says this, you're better off staying the course. Think about that. You don't need to do all these things. And these are the professionals too, by the way.
Right. Morningstar's in the business of, advertising for these professionals. And they're saying, don't use them.
Yeah, and so I think we've covered this topic recently, the Mind the Gap study, the difference between the rate of return of funds and what the investors make, the dollar-weighted
investor return. Yeah, dollar-weighted return.
Dollar-weighted return, how much people actually – so, for example, if you looked at the ARK funds or ARK fund and said, wow, look at that return – very few people that are invested in ARK actually made those returns. They have a tendency to buy at the wrong times, to sell at the wrong times. But it turns out, according to this, and we'll give you some specifics here in a minute, investors in set-it-and-forget-it strategies like target date funds captured the largest share of the fund's returns. In other words, the people that bought and held, put it in a portfolio, didn't mess around with it, didn't care about what was going on internationally or domestically or the economy or whatever. And on the other side of the coin, investors in non-traditional equity and alternative funds earned a much smaller share of their fund's total return, reflecting these strategies' greater complexity, which is something we've harped against for many decades, and greater variability of investor cash flows. In other words, money coming in and money going out. That's also not good when you own a mutual fund or an exchange-traded fund, correct?
Yeah, and the facts are really, the numbers bear this out, and they bear it out incredibly clearly. And this is based on Morningstar's, they do great research. One of the things Morningstar is really good at is number crunching. And they took two portfolios, the average tactical allocation fund versus a do-nothing portfolio, where you just owned the indexes and you didn't do a darn thing. And back in
March of 2015.
April of 2015.
No fooling. Yep.
Put $10,000 in each portfolio. 10 years later, the tactical portfolio, well, look at that. You would have seen that grow to $14,500.
Remember,
However,
10 to
from
14,500.
10 years.
Sounds pretty good, yeah.
Yeah. Actually, it doesn't. Not when you compare it to the dull, boring, you didn't do anything, you just let it ride portfolio. How about over $21,000?
Which
You
seems
didn't
crazy.
do anything.
It seems nuts because all you had to do was get out of the market for the really bad days and then get back in when things turned around, or be in the right types of stocks, right?
All you had to do
you don't own those. Yeah.
All you had to do was be smarter than the market. That's it.
And here's the thing that I find
Why can't we
fascinating
do
about this.
that?
Well, here's the thing. People, if you're doing this on your own, if you're doing, moving money around, and you are because I talked to you, well, I'm waiting for X, or I did it because of Y. The professionals don't do this and do better than a buy and hold, properly diversified, non-tactical portfolio. In summary, by the way, they say it would have been no contest. The do-nothing portfolio would have trounced the average tactical allocation fund actual resorts, a 4% difference per year. You imagine how much that means in you gave you the numbers for the 10 to the 21 and the 10 to the 14.
Well, it means basically over 10 years with the do nothing portfolio, you earned about 7% per year because you more than doubled your money. Whereas with the other one, you earned about 4% per year.
Yeah. And that seems shocking, I think, to most people because they think, well, these are the bright guys. These are the guys that have the inside knowledge of Wall Street. These are the guys that are paying attention every day, which I'm not. They cannot do it. So do not think you can do it. And here's the concluding paragraph, which I love. Tempting, as it might seem, to make changes to your investments amid heightened anxiety, you're better off holding the line. Yes, there are exceptions, as mentioned. If you're soon to retire or newly retired, it could be worth it to take some risk off the table, depending on your circumstances. That, by the way, gets back to the plan.
That's called rebalancing
That's a
to
whole
your
different
risk
thing.
needs.
Yeah, but here's how they conclude. Most other investors should stick with it, for otherwise the evidence suggests they're risking doing more harm than good, foregoing a chunk of their investment's future returns. Says it all, really, doesn't it?
But here's the problem. We have said something like this. We're finding another very powerful voice saying the same thing we've been saying for decades, and yet we know that a lot of you are still actively managing your portfolio because, well, it's obvious that XYZ is going to do better than ABC, particularly with Jimmy Kimmel. That was a joke.
Please.
That was a joke. I didn't say anything more.
Preempted
than
in
Jimmy Kimmel.
Seattle. Yeah, okay, go ahead.
I heard there were protests out there at Como.
There were protests
our old
at
station.
Como TV. Yes, you used to go there every Saturday. So yes,
a radio station.
Fun. Yeah.
Okay. Anyway, but again, why is it? And I would love to know the answer to this. Why do you think you're smarter than not just the market, but smarter than the people who are supposed to be smarter than the market? Why?
Hope springs eternal. Arrogance.
There's got to be. I'm sorry, I don't want to offend anyone, but there's got to be a modicum of arrogance there.
Yeah, I agree.
I mean, we hear it all the time. Well, I know my company's going to do better. Or, come on, Apple, Nvidia, Tesla. They're going to do great. I'm going to own a lot of Tesla Bull.
Yeah. Well, he'll call again. That won't be a problem.
He will call again.
He's a good sport. So, I mean, again, so yes, having the right, but it goes back, by the way, for me still to this other thing that I think we mentioned a couple times, having a plan, because if you have a plan, right, you know what road you're on. You're not shifting depending on, what's going on in the traffic ahead of you. It doesn't matter.
And
so that's one.
The thing is, if you let a lot of your diehards, you're saying, I'm not going to get an investor. I'm going to do this on my own. Okay, fine. But buy a plan from some fiduciary somewhere.
I think that's fair.
Just pay it. It's thousands of dollars. Yes, it is. Sorry, and it's not covered by your health insurance.
Nor is much else I'm learning.
but it's worth
Sorry.
doing at some point. You got to do it. If you have money and if you expect to go into retirement with a comfortable portfolio that will support you in the style you would like to be accustomed, probably should do it. Anyway,
and part two of that is once you have it, the great news is you don't care about any of this stuff because you're already built the right portfolio for your return that you need and the amount of volatility you're willing to accept, because once you've done that, then all of this is noise. Really,
so instead of listening to us, you're replaying late night television comedy shows.
Please, how about some World War II podcast or something? There's for those out there that
I've watched so many World War II documentaries.
Oh, you've watched more than I have now. But I've watched one that you haven't watched.
There isn't any more new stuff to talk about.
Oh, no, I'm talking documentaries in general. I watched one last night I know you have not watched.
What isn't? Don't tell me it's the Charlie Sheen one. I'm not watching that.
Miss Americana.
I don't want to watch that either.
Do you know who it is?
I have no idea.
Taylor Swift.
I'm not watching it.
I watched it. My daughter came on and said, "Why are you watching it?" She goes, "I'd watch that, but why are you?" I said, "I don't know anything about her." So she goes, "Oh, I'll watch it with you." I said, "Yeah, that was kind of the idea." That was pretty smart of me.
Okay. Do you have questions? Those that were sent into talkingrealmoney.com so we can answer them in this podcast or not?
Oh, I have a lot of questions. I thought you were asking like that, asking the audience. Do you have questions?
No, you.
Oh, yeah. Oh, I got.
If you'd look at the camera, you'd see I was looking at you.
Sorry. Well, you don't do that very often. You try to look off. I get it, but still. Okay. Yeah. So you want some now? Is what you're saying?
Please.
Okay.
If you wouldn't mind.
Powell, Ohio. Amanda writes us, "I'm a 58-year-old single female who will be losing alimony money of $60,000 a year in 2030.
Ooh,
I think that's still like 5 years off. Yeah. She has a job. She makes $30,000 a year. I think I'd be better off having my home paid off by 2030 versus putting the extra money into savings. I owe $115,000 on my home. The interest rate is 2.62. Currently, I have $665,000 in my retirement and $45,000 in savings. I believe the peace of mind of having my home paid off is extremely important. Am I right to make the decision to pay this off? The answer is it depends. But the other answer is you should run the numbers. Somebody should run the numbers for you.
Well, I'll run the numbers for you right now.
Well, 2.62 is pretty cheap money.
I know.
That's one number.
Yeah. I know, and it's so easy. So how much are we talking about? She said 150 what?
115 on her home.
115. So let's say you've got that $115,000 and you just put it in something dull and boring like a CD ladder. You just put it in there. You will have $5,100 a year in interest. If
$5,100.
$5,100. I'm sorry.
Yeah. Okay.
Yeah, if you put that same,
I'm like, well, I'll do that. Yeah.
I'm sorry. My brain is getting old. If you put that same $115,000 against your mortgage, which was at what
2.62. It's cheap money. Very cheap.
2.62. It's so easy to do. You save $3,000. So
run the number.
Are you better off with an extra $2,000 a year? I would say so.
Yeah, but the thing is, the answer is I don't know, because if you're 58 and in 2030 you're going to be 63, maybe you're going to retire. I don't know when you're going to retire.
No. Okay, again.
I'm still going to want to say, how much income do you need to take care of things? But you're right. It's cheap money.
Math question.
Yeah.
This is just, and the other thing.
It's not because of what she said. It's emotional, and she's trying to deal with the fact that she says, well, I'll have less money in 5 years.
And so you're going to have less income. So you're going to have less income in 5 years, and you're willing to reduce your income by another $2,000 a year?
I'm not arguing with you about that. I'm simply saying we don't know, because we don't know what. First of all, she doesn't say how much she really needs to live on.
To me, it doesn't matter. It's a math.
I think that's fair.
It's strictly a math question. Your feelings
end up with less.
Your feelings you should have enough control over your feelings to not hurt yourself financially, and that's what you're doing. By paying that mortgage off, you are damaging yourself financially. You are reducing your annual income by $2,000 a year, over $2,000 a year. If $2,000 a year is important in the grand scheme of your budget, and I would imagine for most people it is, Doesn't sound like you're a multimillionaire.
Well, no, she said she has 665,000
Right, that's
in
what I'm saying.
retirement and 45,000 savings, so 700.
Unless there's some inheritance coming, it doesn't sound like you're a rich person. And at where you are financially, 2,000 is a lot of money.
And I guess the other thing we didn't even mention beyond the math equation is liquidity. Once that money is in your house, you can't even get at it.
In the CDs, if you have an emergency, you can liquidate a CD and take a 3-month interest penalty.
Big deal. Not going to matter. Yeah, fair enough. Let's see.
You got time for another. Oh, we have a lot of time.
Okay, good. Alan writes us from Colchester, Vermont. You ever been to Vermont? I've never been to Vermont.
I've been to New Hampshire. Yeah, I went through Vermont on my way to Maine. Yes, I did.
It's syrup or something, right? I don't know anything about Vermont. I'm going to sound
beautiful.
ignorant, but
it's actually really pretty country in the summer. I guess it's pretty in the winter if you like snow.
The fall, don't they have the fall tree?
Fall
thing?
is beautiful. Fall is beautiful. Spring is beautiful.
Noticed here we're getting them here. They're starting to turn.
I personally, I would not mind living in Vermont, New Hampshire, Maine. My wife, on the other hand, never.
Your wife is never going to leave beautiful Celebration, Florida.
She hates cold.
Beyond that, she has 100,000 friends within 15 minutes, so she ain't going anywhere.
Bit of an exaggeration.
Yeah. She says hello. He says. Alan says hello, Don. I've worked 30 years in higher ed and been with TIAA the entire time at 2 institutions. Referring to
Spanish for his aunt.
TIAA, not that TIAA. TIAA as the financial company that was once the insurance company
TIAA.
that works with educators. Yeah, this summer my portfolio went over $1 million. Hey, that's great.
Woo!
Now I can move up and start seeing a wealth management advisor in person where I live. Okay. During the pandemic,
good luck.
During the pandemic, my in-person support went away, and since then I've had only online sessions, which have been fine. I'm essentially in a target date fund for 2035 and do not do anything complicated with my portfolio. Okay, but if you're working with somebody at TIAA, there should be a little more sophistication than just one fund solution. I'm just saying.
Wait. His advisor's at TIAA?
That's what he said. Yeah, right. Seeing a wealth management advisor, and now this is all through TIAA. Yeah.
Okay, this is through TIAA.
Okay. Wonder at times how well TIAA does for me versus going to a fiduciary here in town.
Well, I can tell you right off the bat, TIAA is not a 100% fiduciary.
Yeah. It says they're paid on a flat fee. And this is talking about the advisor you could go see. They're paid on a flat fee on the account value and are legit fiduciaries you suggest people use and have an excellent reputation. My struggle is I'm not sure I understand how to tease out what TIAA charges for services and how to compare this to my local fiduciary.
Oh, okay. I can do that for you right now.
You don't know the name of the firm.
TIAA. No, but I know TIAA.
But he's comparing it to a local firm. He doesn't give the name of the local firm.
Well, but this way he can find out, and he'll know what TIAA charges. I don't know what the other firm charges.
The TIAA probably has 100 different ways of charging people.
Actually, they have a pretty simple ADV Part 2.
Okay.
It's TIAA Wealth Management, LLC. And let's see. I'm looking for. This is one of those. This is one of those ADV Part 2s.
That's going to be 100 pages.
We're gonna.
Yeah, I just said that. It's going to be complicated.
Lots of fluffy prose, like your advisor is backed by a team of investment professionals.
And do they use TIAA products?
Yes. My guess is they probably do.
And where did TIAA come from? Where did they start in the business? They were an
insurance company.
Again, I try to look at things from the root. Not there's anything wrong with TIAA.
How do you see the roots when they're buried in the ground?
It just is a starting place, right? It doesn't make them bad people, but this is where their orientation, this is where they grew from. And it doesn't mean they're going to roll you an annuity, although TIAA does have a lot of annuity products. It doesn't mean that they're going to overcharge you and only use whatever TIAA has available, but they might. And the fact that if you're really working with somebody and they only put you in a target date index fund, I question that, because what would you be paying them for then if it just go by the target date fund? I found their fees. It's really, really complicated. They have a
program advisor fee, and then they add in like other program fees. So it looks to me like they could be as high as, depending on the program you're in, and this is high, as high as 2.05%, and then kind of working their way. That's only on 150,000. Their break points, they break to down below 2 at 150, and then they get to about 1.5 at about $1 million.
Which is still 50% higher than we would like to see at $1 million.
Yeah.
Yeah.
So you can compare that now to your other guy.
Yeah. Here's the other thing, Mike. This anecdotal in a way, but what we see is when you work with a larger institution, it tends to be less personal. When you work with the local RIA that is 100% fiduciary, it tends to be more personal. So some of it depends on what you need, what you want, that kind of thing. That would be another way to look at it. But yeah, I think you should do the analysis. So I think that makes sense. We got time for one more?
Yeah. Well, yeah. And by the way, just to let you know, it really truly, it's their fee is it depends on what they're going to be expenses of whatever they put you into. So that's where that blended fee comes from. No, that's where that blended fee comes from.
I see.
The potential, the funds and their fees. So it depends on the funds they put you into. If for some reason they put you all into, which they're not going to do, like Vanguard index products, then you could be at like, 1.25 or 1.1. But I don't think that's what they do.
No, I'd be surprised. All right. Final question from St. Louis, Missouri. Cheryl writes, I currently have a Vanguard account with a personal advisor, tax and tax deferred. He's recommending going from a 65% stock, 35% bond split to 60-40 this year. Mm-hmm. I'm not risk averse and wondered what your thoughts are. Plan to work another few years, plan to wait and draw Social Security at age 70. My husband and I live pretty conservatively. He's retired, draws Social Security, and also has a part-time job. So I really don't plan on withdrawing funds for a while, and even then, when I do, Social Security will take care of the bulk of our expenses. Is it really necessary to have a 40% bond split at this age, or can I or should I wait a few years? Also, I listened to your last podcast about stock trading politicians. Makes the case against Martha Stewart a joke, in my opinion. Going after a successful woman, it appears inside trading appears to be a common practice in government. I'm sorry. She said you don't have to read this part if it's too political, but she's right, by the way. Yeah. It's a total joke because
it's both sides again. Both sides.
Oh yeah, it's not Democrat, Republican. They're all. We had the one guy that's making what was it like 5,000
trades? It was ridiculous.
Insane. But back to the question.
Your Vanguard advisor. This is what I thought when I first heard it. The Vanguard advisor is going, I feel like stock prices may be a little too high.
Or I got to do something. We got to act like we're doing something here. Yeah.
But let me tell you, this is where our rule is you invest based on a total risk profile. That's a good word, by the way. Make sure you describe what that means. It's an all-encompassing term that combines your tolerance, and you say yours is high, your tolerance for risk, and your need for risk, and you say yours is low.
And the need part is important. In other words, how much is important? How much do you need to return on the port? Right. So again, why would you take risk you don't have to take?
Right. So she has a portfolio that is. She has a profile that is in conflict with itself. She has a high risk tolerance, but no need to take it.
Yeah.
So now we have to find the right balance. One thing I would probably suggest, which I wish all advisors did this. I don't know. I don't think Vanguard does it. Take our risk quiz. It's a scientifically.
Boy, I'd be surprised they didn't, but okay.
Yeah, go take it and see what your risk tolerance is. If you're in the 70 or 80% portfolio risk tolerance, if you like get a 75 score or something, then stick with what you got.
Or even go higher. And by the way, do you have an investment policy statement from Vanguard, which you should, IPS? Because that would outline.
That's part of the plan. That
absolutely
should have been done. And this is part of my issue with Vanguard's advisory service. It is a cursory advisory service.
I think that's fair.
And it's cheap. So it makes perfect sense. You do, in other words, get what you pay for to some degree. because they don't do a lot of personalization, and they certainly don't invest much outside of their own products.
Well, okay, that's fair. I would go back to them and say, okay, why are we doing this? How does this fit my plan? And where does this fit into my IPS?
Investment policy statement.
Yeah.
Ask that. Yeah. Say, how does this fit with my investment policy statement? And if he goes,
if you get a blank look or a blank, there's a lot of hang time on the phone, then you know.
Don't know that you have an investment policy statement.
Then I would be really questioning the relationship, as you said. So that's fair. Great questions, by the way. Really good questions. Love it.
I'm hoping all 20 that I've gotten now from TalkingRealMoney.com that were recorded are all that good. I'm afraid because so many came in like in the last few days.
I think they're going to be one person that called and hung up 6 times.
No, it's
or something.
different people. It's truly different
and
people.
So let's shock Don. Call him more. Keep call. He's got to do something there in that studio. Quit messing around.
I'm going to have to do like hour-long Friday Q&A
I love
podcasts.
It. We'll stay in the car.
You and your grandsons are going to have to
driving
drive around.
It's like, oh, we can't get out now. What do you mean?
Don has another question.
Mr. McDonald speaks on. So go to TalkingRealMoney.com and click on Ask an Advisor. No, contact us. I was messing with you there. I had you go on there, right? Okay.
Yeah. Can I?
No, you can't.
Do a little plug?
Please?
Oh,
sure. Okay. It's your show, too.
A couple of weeks ago. Yeah, we're not at 30 minutes yet. I have another podcast called LitReading, 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 as in reading literature. It has nothing to do with your mouth. Well, my mouth, because I speak the stories.
Yes. I know where we're going with that. I wasn't going to go there, but okay.
And so every week I try. Now, again, I took a 3-year hiatus from this to do other stuff, but I'm trying again to add a different story every week. Now, these are stories that were written prior to 1927, so they're in the public domain, so I don't have to pay the author rights. I'm not paying for something I don't make any money off of. I do make money. I make like $200 a month off of it.
Hey, look, $2,500 a year is real money.
Yeah, real money.
Yeah.
Anyway, I have, since I was a wee lad, always loved to write. I'm just not, life, earning money, taking care of a family, talking real money, doing voice work, doing all this other stuff, building a business, multiple businesses, some that worked, some that failed, all that kept me so busy. I never really sat down and did any writing except
writing is hard. You got to be able to put everything. I found when used to write those articles, I got to be able to turn everything else off. Really. And just go to a place and don't let anybody, there's no calls. It's hard work.
Well, but see, I get all these ideas in my head for stories, for short stories, novels. They pop in my head all the time. And I go, that make a great story.
Yeah.
So I recently, you guys know I hang out with ChatGPT a lot. She's my bud.
Yes, she is.
Well, ChatGPT and Claude and Pseudo-Write, I've started working with a lot of different AIs. And several weeks ago, I had an idea for a short story when I was in Asheville looking at the flood damage. And I thought, this would be a great story. So I was talking to ChatGPT about it, and she goes, that's a great idea for a story. You should write a story. Do you want me to create an outline? And I went, sure.
Could you just write the whole thing and call me when it's done?
No, well, no. Here's how it works. So we got the outline.
Yeah.
And then I took the outline and I said, no, this should happen here and this should go here and I'd like this and, this will add some more tension. And then I said, let's write up just a little bit. So she wrote it up and I went, I don't like your writing. So I went to Claude and I went to Pseudo-Write and I did the same thing with them. I said, here's this outline that we spent a couple weeks hashing it out over the course of hours. And I gave it to both of them, and both of them kind of wrote things. And eventually, and then I added some things, and I took the conversation here, and then they said, no, it might be better if you take it there. And I go, no, I like this better. It was a collaboration.
Yeah.
And we came up with a story.
What's the story called?
Several weeks. It's called A Chance of Death.
Is this the one in my inbox that's still waiting there?
Yeah, it's called A Chance of Death.
But is that the audio version, or is this just the written version?
That's the audio version. Well, if it's on LitReading, it's the audio version. I sent you the printed version, too, the typed version. But it's my very first adult short story.
You're putting yourself out there.
I know.
Good for you.
It truly scares me.
Yeah.
Because the other thing I'm afraid of is people going, written by AI. No, it wasn't written by AI.
No.
It was written with help from AI. And I did a little research, by the way. It's very interesting. You know Alexander Dumas?
Of course.
Three Musketeers, Count of
Going
Monte
back a
Cristo.
few years, yeah.
Yeah. Do you know how he wrote his stories and books?
I do not.
He had a huge chateau that he owned, and he hired dozens of writers and researchers, and he created sort of a hive mind that was called the factory.
You bring the stuff in, you kick it
And
around.
all of
sure.
his people kicked around these ideas.
of
and
course.
So it was like AI, except instead of artificial, it was analog AI. It was like
people. Yeah.
he had people instead of machines doing it.
Yeah. Mm-hmm.
James Patterson, his writing is a giant team of ghostwriters. So mine was I kind of feel
Collaborative.
like it's collaborative. I conducted the orchestra. I came up with the idea. I wrote the basic tunes.
How many words is it?
About 4,000.
How long does it run?
Oh, like I know.
You read it.
I know.
Anyway.
Hold on.
All
I
right.
think it's like 17 minutes. I think it's like 17
so
minutes.
people need to go to Lit.
Yeah, because I would
reading.
really like to know
Get an opinion.
what this audience thinks of the story.
All right. Fair enough.
I truly would like to know that. So you can go to that, and then you can send me a note at litreading.com, litreading.com. I'd like to know what you think, because I've got one other one that's in the works that was a story that I was just dying. I've been dying to tell this story since I first saw Robert Redford. It was after Robert Redford's death, and I came up with this idea. You ever see Jeremiah Johnson?
Of course. Love that
One of my
movie.
favorite movies.
Great film.
Well,
I think that was shot in Colorado, probably.
I don't know, but I came up with a sort of a variation on that story.
That's That's a movie shot in the 70s about him being an outdoorsman and blah blah.
Well, no, it also had to do with killing and
yes, of course,
Native Americans, and
yes, it did.
This one is called tentatively "Murder of Crows."
Oh,
you know what? What is a flock of crows called? A murder of crows.
Murder. That's right. Yeah, murder.
Yeah.
Sure. Yeah.
So the title is "Murder of Crows."
All right. Okay,
And
so
again,
go
that was
to
in some process. If people say these are pretty good, then I might continue to work on Murder of Crows.
Will you do less on this show and let me do more then? You'll be going off on that, doing that?
Hey, dude, anytime. If you want to take over and do some podcasts right there, you just go for it.
Turn the mic on.
Yeah,
Problem is, I
you
can
won't
turn the
do
mic on and I can actually record them, but I don't know how to send them to anybody. So it's like that's kind of a problem because you'd have to come here to the office to listen to them, which is really not how the whole thing works. So. Yeah. Anyway, so go to Lit Reading, listen, and please
or
send
go to your
on,
favorite podcast service. Really,
and
just go to your
send
favorite
him a
podcast
brutally
service.
honest assessment.
I would like to know what you think.
Yeah,
I truly,
like all those other people that send us so nice reviews. It's like, yeah, okay.
Yeah, and by the
I know we
way,
hate crypto,
there is
so.
no mention of Bitcoin or politics.
Oh, thank goodness.
In none whatsoever.
Thank you. Feel so much better.
Anyway.
So,
all right, that's it. That's my plug.
Perfect.
Thank you all.
Well
Thanks
done.
for listening. We appreciate you being here. And please, if you have questions, go to talkingrealmoney.com or call us on Saturdays on our show, which is 3 to 5 Eastern Time, 855-935-TALK. For the inimitable Tom Cock, I'm Don McDonald, and as always, we just hang out here talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from a.k.a. Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by a.k.a. Wealth, a fee-only registered investment advisor.
Please see a.k.a. Wealth's ADV Part 2A on our website for information regarding a.k.a.'s fees and services.
a.k.a. Capital, LLC, DBA a.k.a. Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. a.k.a. does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.